Airbnb for us has been hella profitable. We have bought 2 cabins back in 2021, and we bought the first one in June of 2021. We bought the second one in September of 2021. They're both in the Gatlinburg, Pigeon Forge, Sevierville area, which is super hot for Airbnbs. It's been hot for short-term rentals since like the 1930s. And between those 2 cabins, with only 6 months on one and 4 or so months on the other one in service, we grossed almost $80,000 in rents, and they have appreciated in value by about $300,000 altogether. Now, I think that in 2022, with having a more dialed-in pricing approach, that we can well exceed $80,000 in 6 months. I think that we're really going to kill it this year. And so what I wanted to do is share with you guys how you guys can get into this Airbnb game, own Airbnb rentals, depending on what market you want to be in, but you can own them for as little as 10% down, because that's usually a pretty big barrier to entry for people into any type of rental market, but especially in these really hot Airbnb markets, the purchase prices have gotten, much larger than even the regular real estate market has gotten. And there's really 2 ways to get started in Airbnb. And the first one that I'll talk about here briefly, because I haven't done this at all, but it's worth mentioning, is Airbnb Arbitrage. Now, this is where you rent a home, you rent an apartment, a condo, something like that from a landlord, and you rent that on a long-term lease, like a 12-month lease, and you pay them whatever their rental rate is, and you can negotiate that. And there's channels out there for it. Actually, Airbnb Automated, I watch that channel quite a bit. He does pretty much 100% Airbnb Arbitrage and has a great business going with that. The only downside to that is that you have no equity in the property. You get none of the tax benefits that come along with owning real estate, and the property is not yours. So there's no security in that. So if at the end of that 12 months, or if you're on a month-to-month lease, at any time that landlord can be like, this isn't working out for me, you need to go, and then your business in that particular location, is kaput. Now, the idea with Airbnb Arbitrage is, say that you can rent an apartment or a home for $1,500 a month. Let's say all the utilities are included, and if you can Airbnb that for $3,000 a month, then you make that $1,500 as a net profit. But again, there's no tax benefits, so you're going to be paying taxes on that entire $1,500. Now, what I like is I like purchasing. I like owning real estate. In like I said, this is where you kind of get into the high barrier to entry, because you have to come up with a down payment or cash if you're flush with cash. But the thing is that you have ultimate control over the property. You get equity, you get all the tax benefits. At the end of the day, nobody is going to tell you that you can no longer do Airbnb at your property, and it's something that you have complete control of, and I like that better than having someone else telling me what to do. So if you're not flush with cash, and if you want to get into one of these really hot Airbnb markets, you're probably looking at buildings that are over $500,000. Probably the minimum that you're going to get into an Airbnb in a hot market is $350,000 if you're lucky, and that's probably going to be like a 1-bedroom or even a studio. So a lot of folks don't have that kind of money on hand, and a lot of times it doesn't make any sense actually to pay cash for these because of the way leverage works, because of the way interest rates work versus the rate of inflation. I have several videos on that, so we're not going to dive into that. So a lot of folks use financing, and there's several ways that you can finance these properties, and you can use conventional mortgages, you can use investment loans, you can use all sorts of things. So what we're going to start off with is the commercial mortgage. This is something that most people would use to buy a commercial building like a strip mall, or you can even use it to buy apartment buildings. We used this to actually finance our first single-family home because it allowed us some very flexible parameters to the loan. It allowed us to finance a bunch of the rehab costs of the property into the original mortgage. But the downside was we had to put down 30%, and the terms are much worse. Our loan term was only 15 years. Our interest rate was 6%, while regular interest rates for like your typical single-family mortgage were down in the 3s or so at the time. And so I don't necessarily recommend taking a commercial loan because it usually does end up having a much higher down payment, which is what we're trying to avoid, and having much worse terms for the loan, making it more expensive over the short term and making your interest payments higher. Now, there's a loan product called a DSCR loan, a debt service coverage ratio loan. This is a product that I have not used yet, but I think it's again worth mentioning, because if you do not have W-2 income, you don't have 2 years of your 1099 income if you're an independent contractor, you can use what is called a debt service coverage ratio loan. And what they basically look at is not necessarily not necessarily your credit, although I'm sure those things are taken into account. That what they do is they look at the ability for the business or the project to pay its debt service. And so they'll look at what your debt service coverage ratio is. And if it's below 1, you're probably not going to get it. If it's near 1, that is going to be kind of iffy for them. And if it's up near 2, then the loan will probably be good as long as you meet all their other requirements. But like I said, I have not done a loan with that, so you would have to do your own research on that. The good news is that the down payments for these are about 15 to 20%, and they just carry a little higher interest rate than a conventional mortgage because there is a little bit more risk on the lender. One of the products that I really like for getting Airbnb loans on Airbnbs is the 15% down conventional investment loan. A lot of people don't think that you can do 15% down loans in an investment property, and that is something that you can do. It is a conforming conventional FHA or Fannie Mae Freddie Mac backed loan. And all it is it will end up coming with an investment rate, interest rate, and you will have to pay PMI on it, which for a lot of these properties, for the amount of revenue that they're creating, is not a problem. The PMI cost is not a big deal. The bonus with this is that if you don't make a ton of money, and you're looking to purchase a home that is very expensive to rent out an Airbnb, like $500,000 to $1 million or more, they will take into account the projected income of the property that you're looking to buy and use that to help you qualify for the loan. So it's not just strictly on your debt to income ratio. So if you are looking to do this and you don't have a lot of W-2 or a couple of years of 1099 income to finance the property with, you can use this 15% down investment loan, and you can save 5%. And when you start talking about larger and larger purchase prices, 5% becomes a gigantic amount of money. Let's get down here to the 10% down second home loan. This allows you to purchase a second home, and you can actually have really as many second home loans as you want until you get up to conforming loan mortgage limits as far as how many that you can have. But they have to be in different markets. So you can't just take 6 second home loans in Gatlinburg or in Destin or Joshua Tree or something like that. But the deal is that you can put down 10% on these mortgages. You do have to pay PMI, but it is based strictly on your debt to income. They will not take into account any rental proceeds, any rental revenue, because this is supposed to be used as a second home. These usually come with very favorable interest rates, usually around what you could purchase a primary residence for, plus about 0.25% or so. However, there has been some regulation that's coming out and is in a lot of cases being enforced by banks currently, that they're going to start pricing these second home loans, especially ones with larger balances, at investment level interest rates. But the thing with that is that's not a big deal, because you are going to be potentially making so much money with this Airbnb thing that a PMI and a higher interest rate really aren't going to make that much difference. Now, they offer 10% loans up to the conforming limit, which is different in different states, even different markets within different states, and it frequently goes up over time. You can even put down 10.01% on jumbo loans. The last time I checked was up to $2 million, and use that as a second home. So here is the kicker with the second home mortgage that you're going to be using as an Airbnb as well. And this is where the people are going to say, this is mortgage fraud, you're using it as an investment. You have to legitimately want to use this as a second home in addition to renting it out on Airbnb. We purchased our first Airbnb property with a second home mortgage, but we did have the intent to use it as a second home. We've been going to the Gatlinburg area for the last 4 decades. My folks before that, my grandparents before that. We were super excited to be able to get a Airbnb place that we could rent when we weren't using it, make a ton of income on it, and still have a luxury cabin in the mountains that essentially costs us nothing to use whenever we want. The biggest thing is, like I said, is your intent is that it is a second home and that you maintain control over the property. Being that you can self-manage with Airbnb, VRBO, Booking.com, etc. You're putting the people in, you are running everything on the day-to-day basis, and you are not relinquishing control of that property to a management company like a local property manager or even a virtual property manager like Vacasa or Evolve. You need to maintain control of that property for it to be legitimately a second home. Now, what I always recommend in cases like this is be upfront with your lender with what you want to do. This is exactly what we did. We said we do intend to use this as a second home, and we intend to rent it out on Airbnb and VRBO as much as we can when we are not there. And they said that's fine. They're like that is completely within the legal boundaries of the second home mortgage, and as long as you don't put it under a management company, it will remain that way. So guys, that is how you can get an Airbnb property for as little as 10% down, get you in the game, because we are making between $5,000 and over $12,000 a month with little 2-bedroom, 2-bath Airbnb homes in the mountains. What I want you guys to do is, if you're interested in Airbnb, look at the link down below. It will help you get started with being a host on Airbnb. Also, look at the playlist that's going to be on the screen that goes over all of our real estate investments, our Airbnb investments, to get you more familiar with investing in this space. Guys, if you haven't subscribed yet, hit the subscribe button down below so you don't miss anything I put out on personal finance. Hit the notification bell if you haven't yet. Be sure to give this video a like for the YouTube algorithm. It really helps me out. I appreciate you guys watching today, and I'll see you in the next.